I really recommend that my clients work with a wealth advisor 2 years in advance because you can put in proper tax strategies that can save you millions of dollars at a sale. Millions. That's very important. And a lot of my clients, we go through the process. What do you need to sell? I need $20 million after taxes. I get X. So I need this to live for the next 30 years. Actually, with proper tax planning, that's 13 million of cash after close might be 10. It might be a lot less than you think if you properly plan for taxes and structuring.
This is the Entrepreneurs United podcast with your hosts, John St. Pierre and Rich Hoffman.
Hey entrepreneurs, today we're sitting down with Eric Coonrod, and Eric is not only an investment banker, but he also wrote a book right now that's really popular with entrepreneurs and founders called The Preparation Principle. Eric, welcome to the Entrepreneurs United podcast.
Thanks for having me, guys. I appreciate it.
Why did you write the book, The Preparation Principle?
To educate business owners on what they need to do to prepare for a sale to make sure it goes as smoothly as possible, and then to educate my clients on that, therefore making my job easier when we're trying to sell a business.
Okay.
So yes, please.
Got it. Hey, listen, to make my life easier, if I'm working with people who know what they're doing, what they're trying to accomplish, and all that kind of stuff, you're an investment banker. How long have you been an investment banker?
22 years.
Okay. And what do you love about your profession?
I love working with entrepreneurs, understanding their passion and helping them monetize something that they may have spent 10, 20, 30, 40 years trying to build with their family. And they get the credit and the valuation that they deserve after a very long time trying to build a business. I own my own businesses. It's very difficult to run a business. It's very stressful. I can relate to them, and I want to see them get what they deserve in the end.
Okay. I'd love to ask you, what are these principles? But that'd be too easy. We'd get there way too fast. What I'd like to ask you is, you've been doing this for 22 years. You own your own business. You've seen a lot of successes and maybe even some failures in terms of exits and what's going on. What do you think is the biggest mistake entrepreneurs do related to their business and exit planning?
They don't have their financials in order. That's the biggest one. It happened to me twice in the last 6 months. Had two separate businesses run by fantastic individuals, a great man on one side, a great husband and wife on another business. They thought their companies was about 3.3 of EBITDA each, coincidentally, and both were less than 1.5. After I got in there with my team, went through the financials, and it was a huge mismatch of what they thought was EBITDA and what was actual EBITDA, and that killed both transactions, or at least postponed them. Happens all the time.
Why did you name the book The Preparation Principle versus Principles?
No one's ever asked me that question. I think it's more about the principle of being prepared far in advance. So it's most about the principle of I need to be prepared, and that can have many other facets of that preparation. So just to be prepared and do it far in advance of a sale.
So the principle is far in advance preparation. And what are some of the facets?
You need to hire professionals in their respective businesses to help you do this properly. I lay out the fact that a good investment banker, a good M&A attorney, not any attorney, an M&A attorney, a good accounting firm, a good wealth manager, and a good tax advisor. You need to surround yourself with those individuals about 2 to 3 years out to properly plan and structure a potential transaction.
And give me the why on all five, because I imagine entrepreneurs listening may say, on that checklist of 5, I think I've got 2 of those. I've got 3 of those. I don't know if I need the other ones. Can you break those down on why do you actually need each one?
Great. It's a great question. We'll start with a banker. That's me. I think that you need an investment banker to run the process. As doctors don't operate on themselves, if you're a business owner, you shouldn't sell your own business. Let someone outside who does it for a living do this. We have access to buyers and sellers. We know buyers for your business. We know how to structure it, how to value it, how to help you with all the potential pitfalls before they happen. You need to hire an investment banker to run the process. Do not do it on your own. An attorney, extremely important, right? You're going to sell your business. You need to make sure that you're covered. Do you have all your reps and warranties? Are you covered? If you've done everything legally, and make sure you're prepared to sell that when you sell something that they're not going to come back in 12 months and claw back purchase price because you said something that wasn't true. You must have a good M&A attorney, a good accounting firm. A lot of my businesses that I sell bigger businesses than smaller businesses. The smaller ones do QuickBooks or they might be cash-based accounting, and it's not done properly. It happens all the time. So you think you've got EBITDA of 3 and it's 1. So you must have a good accounting firm review your books prior to a sale. It doesn't have to be an audit, but at least a review. A wealth advisor. I really recommend that my clients work with a wealth advisor 2 years in advance, because you can put in proper tax strategies that can save you millions of dollars at a sale. Millions. That's very important. And a lot of my clients, we go through the process. What do you need to sell? I need $20 million after taxes. I get X. So I need this to live for the next 30 years. Actually, with proper tax planning, that's 13 million of cash after close might be 10. It might be a lot less than you think if you properly plan for taxes and structuring. And the last thing is the tax advisor. You work with a private wealth manager, and they give you tax advice with the wealth manager and with me and with the lawyer on how to properly set the company up for sale.
Which one of those 5 do you feel like entrepreneurs struggle with to either find or accept that they need?
That's a really good question. That's a good question. Often, believe it, I think it's oftentimes the M&A attorney. They have their attorney that they've had for 20 or 30 years. They love him. He's helped them with their corporate docs. That's not an M&A attorney. And that had happened quite a bit. They're not going to leave this person. They trust him and respect him. That's great. They're not an M&A attorney. So that's a tough one. Yeah. And by the way, I live in Los Angeles, and attorneys, they're getting more and more expensive every day. So it's tough to convince my client, you need this. That happens quite a bit. Great question.
Are M&A attorneys difficult to find, or is it just somebody believes they have an attorney and an attorney's an attorney and they'll make sure the paperwork's right? Or are they challenging the find?
It's the easiest thing for me to find. Eight out of 10 deals, the M&A attorney is my friend. I've got so many to work with, and I make introductions to all my clients. I usually make about 3. One lower end, one middle, and then one very high level. And they pick what they want with what's most comfortable and what's most price efficient. But that's easy to find for me.
I have a question. This may be going down the weeds a little bit, but I'm just curious. What is the one wealth tax strategy that you've seen recurring more and more frequently as of late for entrepreneurs selling their companies that takes a little bit of forethought and planning?
It's a great question. I am not a tax advisor, so I want to put that out there. But what I've
Yeah.
seen a lot of my clients do recently is put their assets in a remainder trust.
Is that the same as an irrevocable?
It is.
Yeah. So I'm in the process of evaluating that. So in that process, you may own 100% or 50% or 20% of your company in your name, probably because you started it 15, 20 years ago. And the idea here is that you would take a certain percentage of that, and usually a minority percentage, and gift that to an irrevocable trust, sometimes in a slat, like a spousal lifetime trust or something like that, right? So it's an irrevocable trust, means you can never get it back, but it goes in at a discounted value. And the benefit of that, Eric, I think if I understand it correctly, is that gets exempt from really the death tax ultimately down the road, because it's an irrevocable trust. So if that grows over time, that money, that investment portfolio, it meets your exemption limits. That's just a general gist of what I got from that. Is that correct?
Generally speaking, yes. It is a legal way to really save on taxes. Yes, correct. Now
Okay.
and in the future.
Gotcha. You mentioned one of these facets, and we've gone down the road of, hey, hire your team of protectors. And I love that. I'm very passionate about having a team around where you can look by. Are we all on the same page what we're doing here? M&A counsel, wealth, tax, everybody's on the same page. This is what we're doing. I'm sure there are other facets as well that are in the preparation principle. What would be other facets you have you didn't even really address yet, because we didn't ask you? How long ahead of time should you prepare? It is the preparation principle. Is it 2.5 to 3 years? Or is it when you start? How long do you think it takes to prepare for this preparation principle?
It's never too early. I tell people that are starting a business, when you're planning to start your business, plan for the sale day one. Maybe it's 5 or 10 years, but always know what your exit strategy is. I start my business today. I want to grow it for 5 or 10 years. I hope to have this growth per year. And of course, you reset every year, but have the exit in mind day one. If I don't get that often, and when I do come talk to my clients, I'm different. I came to this conclusion a couple of years ago, 10 years ago, that I'm going to get in very early. If they're good people, no jerks. If they're good people and they've got a good business or service, I will give them free advice for a long time, accounting advice, expertise, or send them to the right people. I will help them get ready for a sale far in advance. At that point in time, I tell them at least 24 months minimum to maximize to maximize valuation in a sale at least 24 months prior. You can
Got it.
do it the day, you can do it without any preparation, but you're going to go, I think you'll get better valuation, save money in tax if you plan 2 years in advance.
Yeah. When you were saying that, it was reminding me of being a sports agent, right? You're investing in time and relationship with a potential future prospect that may never sign a pro contract, or they may not even go with you when they sign their pro contract, but you're making that investment of time in entrepreneurs for the future opportunity of working with them when it is time for them to go. So what kind of work would you do if an entrepreneur is listening to this, you know what, I'd love to start thinking about this. What kind of consultation or work would you do with them today in anticipation that in the future they may have an exit opportunity?
That's a great question. Let's first of all give me a call and we'll talk about the sale process. 6 to 9 months. I talk about that. I go into more detail about how you should prepare. And by the way, I have friends in these different categories. I'll make introductions for you. And then I'll look at their business model. If it's a business model, I know I had one particular client who I talked to him every quarter. I talked to the CFO every quarter to look at his margins, his growth. I helped him with growth is like this, but I'm spending a lot in marketing. So my EBITDA margins they're being impacted a little bit. Well, then we might pivot next month and go more for margin sustainability and less growth. I would talk to him every quarter. He chose a much larger investment bank, by the way, after 2 years of doing that, but it happens. But I can do a lot in advance. And again, I can't talk to him every day, but I might give him a couple hours a quarter. Happy to do that in the hopes they hire me in a couple years when they sell. But I can do
Okay.
it. I can actually give you a lot of advice and put you in contact with the right people that'll give you even better advice or more detailed advice.
Yeah. It's kind of one of those, to your point on getting the right team of protectors, is that if you're looking at it as a cost, you're looking at it the wrong way, because one piece of advice could save you millions of dollars, to your point, right? And
Really.
that investment in getting the professionals that have done it before over and over again can really save you a lot of heartache and a lot in your pocketbook. Eric, we went through, to my knowledge, there's, in addition to the preparation element of this, I got two things so far, and Rich, maybe you got a couple more, but I'm curious. You got to have your financials in order. It's the biggest mistake I see. So yes, you have to have that. And two, you have to have the right professionals that you've hired to be around you. Those are two things I heard that were very clear. In the book Preparation Principle, do you have a checklist of all the things you should be doing, or is it like just more of the concept of preparation?
Yeah, I don't have an actual checklist, but I do go through chapter by chapter of there's different parts of a process, and I take it piece by piece, planning, and then the process itself. But I do something else that you haven't asked yet, but I'll get to, is that the entrepreneur must need to figure out what they're going to do after they sell. Think about it. This business is like their third or fourth child. It's their baby. It's all they've known. They sell it, and sometimes they lose their identity. What do I do next? Maybe I don't play golf every day. What am I going to do with my time? So I really, before they sell, I talk to them. What are you going to do once you sell? Once you're no longer in charge of this business, are you going to feel fulfilled? Because I've had it happen before where you work 9 months, a lot of time and money spent. At the last day, the seller's like, I don't want to sell. I'm like, whoa, wait a minute. Okay, go get a cup of coffee or your favorite glass of wine. Take an hour and give me a call. Let's figure out why we're here, why we put all this work in, because they feel guilty. Quick story. I had one man, 6'5", burly of a guy, right? Just a guy's guy. He had a business that was a foundry. They melted metal for hose bibs. We're signing the contracts. Back in the day when you signed it in person, he was crying because he felt like he was letting his grandfather down. His grandfather started the business 50 years ago. That's why I go really deep about, okay, we're going to sell the business for this with this buyer. What are you going to do after? Let's put out a plan for you to work for the next 10, 20 years of your life. You got to do something or you'll be bored. So that's a big part of it too.
So break down that for me a little bit on the process or framework you recommend for entrepreneurs as they consider what they do next. Beyond, hey, you should consider that. You should think about what you love. Is there something more than that you recommend that they do to really dig into it and become confident about what they do next?
Yes, oftentimes my deals are a majority recap. And what that means is the seller doesn't sell 100%. They sell 70% or 80%, and they roll the extra 30 or 20% into the new co that a private equity firm creates. So the private equity firm comes in and says, I know how to fix businesses and make them more efficient. You know how to do what you do. You're an expert. I'm going to buy 70%. I'm going to allow you to roll 30% into new co, and you're still going to run the business. However, you're going to be able to do the stuff you love to do. Maybe it's sales. Right? See, entrepreneurs start a business and they have this great idea. I love to sell certain things, but then you got a problem with HR and legal and accounting, and they get away from all the stuff they love to do. They're doing all the stuff they can't stand that they hate. So they hate the business. I say, what if I find you a buyer Unless you go back to doing what you love to do, maybe it's sales, all the HR, accounting, all that stuff off your plate. Someone else does that. Like, that's fantastic. I can go back to doing what I love. Yes. The next 5 years. So that helps them with the trans. If we do that, then as they're doing that, they're not working 80 hours a week. They're working 20, 30, or 40. And then we figure out what your hobbies are. Is it golf? Is it tennis? Is it more time with your grandkids? We talk that through. That's one way. If they sell 100%, it's kind of the same thing. What do you want to do? What have you always wanted to do that you couldn't do because you were so busy? Is it painting? Is it picking up golf? Is it whatever it is? Is it vacationing? We talk about that in advance so that when they sell, they have an idea what they want to do. And again, very rarely when they sell the business do they walk away. Oftentimes, for at least 6 to 12 months, they're involved in the business with the transition. So that gives them time, too, to think about what they want to do with their life post-sale.
If somebody were to sell 70 or 80% of their business under the idea of, I get to just do what I love and have other people do the other part, how could that go wrong?
That's another very good question. And it happens more often than I'd like to admit. How could that go wrong? If it wasn't properly structured, that 20% could be taken away quite quickly. There's some pretty sharky people out there that are not fit, that are not good people. They may be, if it's not structured properly, the 20% could go away. If you're rolling 20% and the purchase price is based on an earnout, and let's say that earnout is EBITDA focused, you can play a lot of games with that. And EBITDA might be 3 million, but the buyer says no, it's actually 1.5. You don't get your earnout. That can go sideways. The mismatch between buyer and seller of the management team, right? They're going to have some people on the management. You will too. They may say, I want to do this and this, and I'm going to spend money here to market. And in 6 months in, now I changed my mind. No more marketing spend. There goes the business. Yeah, a lot of times it's going to be the mismanagement between the buyer and the seller. They don't gel, they don't get along, or the buyer says some things they don't do. They renege on their promises, and the buyer and the seller's kind of stuck. I try to prevent that by proper structuring, but those are a couple of ways it can go wrong, and sometimes does.
Yeah, thanks for that. If we take those three real quick, what is the antidote to that? That prior to the selling of 70 to 80%, and I'd love to go one at a time, the not properly structured and the 20% goes away. What's the antidote to that to make sure that doesn't happen? When you say, and obviously the answer would be it's properly structured. What's the one or two proper structure pieces that need to be there?
That's a good question. This is going to be technical, but I'll try to keep it simple. There's different classes of stock, right? You can do Series A, Class A, Class B, Class C. When my clients sell, I want them to sell pari passu. That means that the buyer has a Class A stock with all the rights. I want my seller to have the same class. Oftentimes they're a class lower. So, right, there'll be a Class B. They don't share the same rights as the Class A. So there's one example right there, Rich, where they can be diluted even further than 20%. There may be what they call a participating preferred. I won't get into that. That's a very complicated structure where the buyer gets paid back maybe 1.5 times before the seller gets anything. That they can be diluted really easily that way. That's one way to structure properly. Make sure you know that you're the same class of stock and have the same rights as the buyer. That'll help with that.
And what about number two? So where the earnout ends up being negotiated unfairly, what's the antidote to that one?
Go to revenue. So the higher on the income statement you have an earnout based, the less they can play games. For instance, revenue is revenue. If my earnout's based on revenue, you can't really play much games with revenue. Gross profit. If they say no to revenue, go to gross profit. Where you got to be careful there because you can do a lot of sales at a discount, and that lowers gross profit. And then oftentimes they're based on EBITDA. So the further you go down the income statement, the more room there is to play games with. Extra expenses, no credit here. So try to keep the earnout based on revenue or at least as high on the income statement as possible.
Great. And what about the management team mismatch? What would be the antidote to that one?
To spend a lot of time with the buyer in advance of a sale, and a lot of time. Once you're down to the last 2 to 4 weeks, get face to face in a room, plan out the budget for next year and the following year and the team. And if they're going to bring in somebody new, the new CFO or controller, meet that person. Can I work with that person? If you're the head of sales and you've got someone who's going to be on your sales team, know that person, get to know them. Do you guys and gals, do you gel? Do you get along? Make sure you know who's going to be on the team and you spend a lot of time with them prior to sale to make sure there's a fit.
Eric, I just for the purpose of fun, want to provide maybe a different angle, and I'd love to get your perspective on it. if Rich had asked me the question, maybe not on the management team, but if he had asked me, what do you think the antidote is to not getting diluted post a sale or not being in a position where your earnout gets affected? My answer would have been, don't do it.
Don't do it.
And the reason why I would say that is because, and you kind of alluded to it as well, there is more bad examples than good right now of private equity firms coming in, buying companies, and doing whatever financial engineering or paperwork engineering they need to do whatever they need to maximize their returns and take over. And I have a lot of scars, just as you can probably tell, where that happened to me. And what I would say, you posed a really good question, which is, why are you selling and what are you going to do next? And I'm curious, the way I view it now too, Rich and I both coach entrepreneurs, and a lot of it has to do with what are you trying to accomplish in your life? Like, where are you trying to go? And what I would be saying to them is, okay, you want to sell your business in 3 to 5 years? Okay, sounds good. Can we build a management team and a leadership team in your like succession in your business so you're an owner, not an operator in your business? Is there a way to make that transition, take that transitional time before you sell? So when you're exiting the business, you're really exiting, because a lot of founders are not really good employees.
Right. That's
and
right. Yes.
and they stay on board and they don't agree with the cultural pieces and they don't like the financial engineering and they don't like the red tape that comes in, and they're more disgruntled sticking around. I would say take the time to build succession in your business so that when you exit, and if it's not time to exit because you haven't maximized your value, then maximize your value. Bring in the people in your team, maximize value, and then exit 100%. Now, I do know there are companies that will only buy 80% or 70% because they need you to roll it over. And if you're going to roll over, my viewpoint is roll over as an inactive participant with the same class of shares. I'm pari passu with you guys, but I'm not operating, right? We have the team that's operating. Talk to me about that. Because I have these scars, but I'm curious as to when you work with entrepreneurs and helping them with their planning, is that part of kind of the conversation at all in terms of helping them get a clean exit?
John, that's a good question. Yes, it is part of it, but you're making me think about something. So I'm planning book number 2, and I couldn't figure out what it is. And I'm being literal. You just gave me what number 2 is: proper succession planning in advance of a sale. So let's take an example. Oftentimes, if the children, the son or daughters, want to take it over, you do it that way. I've seen it happen quite a bit where son or daughter takes it over and they're in the role of 2 or 3 years prior to sell. So the transition is great. The founder, they go to chairman, and then the son or daughter is CEO or president. That works out really well. Unfortunately, more and more nowadays, that's the kids don't want to take it over, especially if it's manufacturing. If it's dirty and they don't want to do that. Maybe if it's SaaS or software, great. Manufacturing, little less and less. But you are correct. That's something that I should do more of, actually, is bringing a professional that's going to talk about how we take mom or dad and get them the chairman and let someone else come in, hire that CEO, hire that replacement far in advance of a sale, so that when the seller wants to sell, they can sell 100%. The buyer's comfortable that the CEO or president sticking around. They incentivize them to stay, and the seller walks away. That's a great idea. Yeah, it happens.
Yeah, love it.
I should plan for it every time, though, or at least make it an option every time. That's great.
Eric,
Yeah,
when you write that book, would you come back on the Entrepreneurs United podcast and tell us about it?
Yes, sir. Absolutely, Rich. Yeah. I've been talking to I work with a guy, and I'm going to call him today and say, I've got the idea. Let's start the process. Yes, sir. I will come back on for sure. Yes.
Love it. Yeah, I'd love to do that, Rich. Great suggestion. Eric, thanks for joining us on the Entrepreneurs United podcast. How can people learn more or connect with you?
John, Rich, thanks for your time. Yes. So my website is ecoonrodco.com. So ECOONRODCO.com. My phone number, I'll give it out, 310-995-8579. And Eric Coonrod, I'm on LinkedIn as well. Reach out to me. My email address is Eric, ERIC, at ecoonrodco.com. I'm available that way. I'm always open to have a conversation with anyone. If it's half an hour, I will always give you 30 minutes of my time just to talk. If it's a fit, great. If I'm not the right person, I'll send you to the right place.
Love it. Thanks for your time, Eric.
Thank you, Eric.
Thanks, guys.
Stay tuned as John and Rich unpack today's conversation.
John, with your experience, and I know you didn't get into it with Eric, but you said I've got some scars. With your experience in things not going well, is there anything you learned on this? Or did this just reinforce what you learned after a bad experience?
Reinforced,
Okay.
I would say, for me. reaffirmed, reinforced. Like just, I loved his first answer when I said, what's the biggest mistake people make? And it's, they don't know their numbers. And Rich, listen, you know that I love the numbers, but I can tell you the time where we brought a private equity firm into our company, the numbers weren't as tight as they should have been. And we had grown so fast. There were so many different systems, so many different, it just wasn't as tight as it needed to be at that time. And that created a vulnerability to be exposed. We almost sold the company a few years ago and we didn't end up selling. And afterwards we're like, oh, thank God, because some of the numbers just were not correct in our systems. And this is somebody who like loves numbers and loves spending time. So imagine the entrepreneur who's not a numbers person, who doesn't really look at their QuickBooks numbers, doesn't really pay attention to it, looking to go sell their company. It's 10 times worse than that. And so the discipline there is really lacking. That was reinforced for me in this conversation. And I continue to see it over and over again with the entrepreneurs that I work with. And I love where we ended up, because my big learning, and continues to be the big learning for me, is there are a lot of people out there that are trying to buy businesses for zero down. They're trying to, private equity firms are trying to buy businesses and, try and get the best deal possible. And by the way, the reverse happens. Entrepreneurs are trying to sell their business as high as possible. Isn't that natural? I want to sell my business for the highest value possible. But when you sell your business beyond its value, and there are any vulnerabilities in the agreements, they'll take advantage of them. If you just screwed me, if I just bought your business for $2 million and it was really worth $1 million because you didn't disclose to me a couple of things, I'm suing you. I may sue you for $10 million. You know what I mean? So entrepreneurs really need to be careful, because if you try and sell your business for more than it's worth, and it's really not worth that, you may end up paying the price in the long haul for that. And it's contradictory to what you think. Like, I'm going to sell my business for as much as possible. That's their problem. But what we talked about with agreements and representations and warranties and everything else, there's some vulnerabilities that could exist that create legal issues down the road. So knowing your numbers, knowing what your company's really worth, is something that's really important.
I got to say, there's several things I like about Eric. He was very knowledgeable on the topic, felt like he could go to almost an endless level of depth. And then in some of his answers, he was moderate. I don't want to go too far on that. And then he would explain it in more simple terms. And then another thing I really like about him is I really got the impression about his generous heart when he said, I'll give 30 minutes to anybody. He's the first guest who's ever given their cell phone number on the podcast. And talk about follow through on being like, hey, I'll give 30 minutes to anybody. Call me. I'm happy to help. And then did you hear about 60% of the way through, he said something very quickly, and I was going to follow up on it, but I didn't, is he said, no jerks. Did you hear him say that?
Yeah.
He said, no jerks. I don't remember the name of the guest. If you do, that would be great. Who told us is she had a no jerks policy.
Yeah.
And when we asked, so how would you define a jerk? And I almost wish I would have asked Eric, what is a jerk? How do you know somebody's a jerk? But I love the answer we got from our former guest, who I can't remember the name of, is she had said, a jerk is somebody who makes everybody else's life more difficult. That's the person who's a jerk. And the jerks know who they are. And she had the jerk test.
Yep.
So one of the things we should put in the write-up of this is, if you wanted the jerk test, go to episode such and such, and we'll look that up. But I'm sure Eric would agree that a jerk is somebody who makes everybody else's life more difficult. And if there was a test for it, which there is, that would be great to know who's a jerk right up front.
That's funny. I love the tease that you're not going to share what it is. It's episode 202.
We were not allowed to share.
Free bubble with Kristen Zhivago.
Yeah, Zhivago. We were not allowed to share, if you remember. She said,
that's right.
She said she would not share because then all the jerks would know. So we ended up getting what that test was.
That's right.
When we were in the green room after we recorded. So here's the bigger tease. If you want to know the jerk test, reach out to us. We'll tell you one-on-one, but we can't tell all the jerks on the air right now.
Yeah, that's so funny. I forgot that it was a secret. So thanks for reminding me. Yes. I was about to just throw out the test.
No,
it's great. Listen, I think it's really important. Who should call Eric? Everybody. I don't care if you thought about selling or not selling. If you own a business, you run a business, why not take 30 minutes and go, hey, I don't know what I'm going to do in the future, but I'd love to get some expertise from you. Free consultation from it's like a sports agent, right? Who he'll invest time, give you referrals, point you in the right direction, maybe give you some things to think about. And I think that identity one's a really big one, Rich. If you sold your company, what would you go do? You're complaining and lamenting that maybe you don't want to do this anymore, but what will you be complaining about if you sell your company? You'd be complaining, well, what should I be doing? I should probably be doing the thing I just sold. So there's a lot of different things. I loved where he went to the life part of this, which is it's preparing you in the preparation principle for what's beyond the business, which I thought was really awesome. Great episode with Eric. Can't wait for next week's conversation.